For those of you who don't know, my name is Alicia Dicks with the Community Foundation. Welcome to our donor advised Fundholder meeting, and thank you for joining us. Again, just a couple reminders: mute yourself, and we will answer questions at the end, and then again with Mike Miller. So now I would like to introduce Michael Miller, Chief Investment Officer of Crewcial Partners, formerly known as Colonial Consulting. Mike has been our investment consultant for many years. Today, he will be providing updates on our investment strategies and performance. Following his presentation, he will be addressing questions. Again, you can put those in the chat. And with that, Mike, I will hand it over to you.
Thanks, Alicia. Thank you all, and really nice to be with you this afternoon. Thank you. So if we can, as Alicia said, I'm going to talk about performance, the strategy we pursue, and also a little bit or a lot about what is keeping us up at night these days, because there's plenty to think about there, even beyond the pandemic, of course. So if we advance to the next slide, let's start with the performance. Last time I saw you, we were in the midst of the pandemic's worst impact on the market, many of you, I should say. And a lot has changed since then. As you all know, the markets have come roaring back until very, very recently. And the portfolio had been struggling mightily in the spring, predominantly because it's got a bias towards out of favor ideas, places where we actually think we can earn strong long-term returns. One of the big themes I hope to leave you with today is that this is really, we like to win these short-term horse races, of course, as much as possible, but it's really not nearly as important as preserving the long-term value of your capital. That's ultimately what matters at the end of the day. And sometimes those short-term horse races, the only way to win them is to do foolish things on a long-term basis. And that's just absolutely not a place we're ever going to go. So what you're looking at on this screen is the performance, which are the blue bars of the foundation's main investment pool, compared to two benchmarks we use, 70% global stocks, 30% bonds. That's the red bars you see. And then the green bars are what we call a custom market benchmark. A little bit later, I'll show you the strategic asset mix of the portfolio, which is the policy mix, we call it, between stocks and bonds. And we use a benchmark that reflects each of those little nuanced pieces. So it kind of measures, or does measure for us, how are we doing compared to the asset mix that the foundation actually chose. The 70-30 is only here because it's got similar levels of risk to the strategy we picked, but it's not the perfect benchmark from that perspective. So what you see is kind of a lot of different things going on this page. The first thing you see is that those blue bars, particularly over the year, 3 years, even after 5 years, are basically mixed to slightly below our benchmarks. And so that's the horse races I was referring to earlier. Most of that happened, by the way, in the last 2 years, from really 2018 to 2020, early 2020. What you can also see, though, is since March 31st of 2020, the portfolio is actually beating both of those benchmarks by a considerable margin. And that's the rebound that's occurred in the markets, and also in a strategy that's still actually not particularly popular in the markets right now. A lot of the what are sometimes referred to as pandemic winners, which is a terrible phrase, but companies that have benefited from the pandemic, some of those stocks have done very, very well. We own less of those stocks than others might because they're too expensive today. We'll talk about that a little later. But the other thing I want to observe, and this is going to become the big issue for us, if you start looking at 10 years where the results are very similar to the custom benchmark, a little behind the 70-30 because the portfolio is not as risky, and then 15 and 20 years where the portfolio is outperforming both benchmarks by what looks like very small margins. But let's switch to the next slide, Alicia, if you don't mind. So these are the same numbers, believe it or not. However, what we've done is we've changed one benchmark, and we've also changed the way we're showing performance. So everything on the slide before was per year, everything being net of investment fees, just to be clear. This is not per year, this is cumulative. And this is a really important thing, which is even small cumulative premiums. Do you mind going back to the slide before for just a second? So if you look at 25 years, you see how the portfolios earn 7.9% per year. And since we're carrying forward the 70-30, you see how it's returned 7.1% per year. And it would be quite reasonable for someone to say, well, that's good, but what's the difference? What's the big deal? You could have avoided the short-term underperformance by just owning the index, and we would be just as well off. So now if you go back to the next slide, look at the comparison on the 25-year column between the blue bar, which the only difference from that in the page before is instead of showing it per year, we're just compounding it out over 25 years. And it's a massive number, 569% of cumulative return over 25 years. Whereas that red bar, the 70-30, is up 455. So that's the 7.9 to 7.1 I just showed you a minute ago. That's what happens over 25 years. You multiply that times tens of millions of dollars, and you're really talking about something here. And so that's why we don't worry too much about these short-term horse races. And you can also see, if you look to the left, while we've underperformed, the portfolio's underperformed, those are relatively small gaps, and they can be easily made up over the long term. And that's a critical element. The last part of this pie, which I'd like to emphasize, is the green bar, because I think a major point here is that the portfolio is positioned to generate absolute returns that support consumer prices plus a 5% distribution rate. And that's important because that's the whole concept of endowment and intergenerational balance that we're trying to achieve here. Having your funds be, and to the extent that you want them to last in perpetuity from a purchasing power perspective. So what's very interesting is you can see, even with the underperformance versus the red bar, we've outperformed those green bars. And that's something we are very, very focused on. Underperforming those green bars is a real money issue. And we'll talk about that a little bit later in terms of how that works. But I think the last point I'd leave you with is over 25 years, which is a long period of time, admittedly, if we had just been in the index, we would have fallen short. We would have failed to preserve purchasing power over the last 25 years. Being in the funds that we've had and the strategy we've pursued, the portfolio has actually dramatically outperformed CPI plus 5. And that is really the outcome that we're looking for. I will tell you this, we would love this to be consistent and to always be outperforming and never have to talk about underperformance, but there's no real way to do that and achieve what's on the far right-hand side of this. So we advance to the next slide. Here's the philosophy which is at place. Now, one of the things that I'll spare everyone what'll sound like a dumb answer to probably a good question later. We don't know where interest rates are going. We don't know what the economy is really going to do this year. We don't know what the markets are going to do. When the market goes up a lot, we're surprised. When the market goes down a lot, we're surprised. We're not focused on those things. We're focused on a very simple equation, which is what we described here, which is long-term returns that we think can be earned from intelligently allocating capital. So I'll talk about what that means a little bit later, but that's the whole focus, is what should we expect over the long term. The second point, as you can see in the middle, no economic forecast, no short-term forecast. And I know a lot of you are been conditioned by lots of people to believe that, well, you should probably try to predict what will happen in the economy this year, because that'll tell you what you should own as an investor. And that is true until it's not. And the problem we have with that is, one is, who knows what the economy is really going to do this year? I mean, we can all have our educated guesses, and I certainly have mine. But the fact is, it's not a fact that we know what will happen. It's a lot of uncertainty. And 2020 was a fantastic example of how, if you went back into January and asked people what their forecast was for the year, it wasn't anything like what actually happened. And you might say, well, how could they have known? And that's exactly right. How could they have known? And the same problem is always facing us. How do we know? We don't know exactly what's coming next. So we don't want an investment strategy built on knowing something we can't know. So the last point, which is, because we don't know, and because your capital is incredibly important and cannot be risked in foolish ways, we diversify by strategy. And that's a major, major element of the strategy. So think long-term. Don't get sucked into short-term guessing and predicting and hoping that we're going to get something right out of pure dumb luck. And instead, focus on risk control through diversification. So the next slide is the strategic mix of the portfolio. And as you all know, we live in a world of very low interest rates, which is a very big frustration. So if you're watching the markets carefully these last few weeks, you'll notice that interest rates have started to rise again, and the markets are starting to freak out a little bit about that. And nothing, by the way, makes us happier than interest rates rising, because when they rise to enough of an occasion, that will give us a better set of choices for investing. But the choices we have today are very low return bonds, and we need to own some. You can see the 28% listed here, and they silly stocks. And we don't really want to touch the alternatives for the most part, because they're complicated, expensive, illiquid, and frankly, the odds aren't very good in those spaces for the most part, although there are ways to succeed. And we've buried a couple of alternative funds inside the equity portfolio currently. But you can see the mix at the top, 72% in stocks. So when the market struggles, this portfolio will have its volatility like we saw in 2020. Although we expect the next time the market really takes a dip, it will not underperform like it did in early 2020. That was a very unique situation with the pandemic. And the last thing I'll leave you with is specialized global equities. That's the real secret sauce of this portfolio's long-term outcomes on a go-forward basis, which these are very high octane, really, really compelling managers that the foundation, as a major institutional investor, has access to. And we can talk about that more if you'd like as well. But that's one of the really special things about pooling capital as the foundation has on your behalf. So the next slide is the thing. And I'm going to spend a few minutes on this. We are absolutely terrified about the future for philanthropic capital at this point in time. And the reason we say that is because we live in a world where interest rates, as I mentioned before, are very low. So you're not going to earn CPI plus 5 on a bond portfolio today. And we live in a world where the things people want to own, big successful growth stocks, the S&P 500, et cetera, are priced in that they're just not going to generate good returns on a go-forward basis. And that sounds like so we're looking. I can't think of the word I'm looking for. That sounds like a crazy thought, but it's really not. And I'll show you why it's not a crazy thought in a minute. But the fact is that there's an incredible set of risks out there. And when we model out what will happen to an investor who puts 70% of their money in the S&P 500 and 30% in the bond market, we actually would argue that they'll probably destroy somewhere between 40 and 50% of the real value of their funds over the next decade. And it's a very quiet enemy. You won't see it. It won't be one of these loud things like you see in the markets dropping like we saw in March of last year. It'll just be a quiet erosion of capital. And you'll wake up 10 years from now and say, oh my gosh, this is a disaster. But there is good news. There are actually plenty of places to overcome those odds. And that's what we're going to talk about today. If you go to the next slide. So let me try to justify the S&P 500 point, which I know might sound like complete insanity to many people. And that's why it's going to actually happen, I'm afraid. So this is a little technical, but I think it's really important. So Bob Schiller is a professor at Yale who came up with this idea of the Schiller Ratio. So a lot of people will, do intrinsically understand that there really are two things that go into investing. One is what are you buying, and two is what are you paying for that thing that you bought. And valuation is our term for what you paid for something. So the Schiller Ratio, not to get too technical, this will be very quick, I promise, takes 10 years inflation adjusted earnings. So you just go back over the last 10 years, look at what the S&P 500 in aggregate earned. That's the US stock market, by the way, and just increase it by the rate of inflation, take the average, and then take the price of the index today divided by that 10-year average, and voila, you have a ratio. So what you can do, which is what we've done here, is we've gone back all the way to the 1800s, which is what Bob's data goes back to, and looked at every single Schiller ratio all the way back in time. And that's all these observations that we put in these different buckets. So the orange shaded line is where the Schiller ratio is today. At least it was as of March 1st. It's actually a little lower as we speak, but basically the same. And what's really a few things. One is take a look at how few times in history it's been that high. That's a really, really interesting point, I think. Now look to the right, though, which is what were the returns for the next 10 years. So when we had each of these buckets, what we did is so the Schiller ratio on March of 2000 was this. On July of 2008, it was this, and so on and so on. And what was the next 10 years return for the index? And you can see if you just scan the right-hand side, that very last column, you can see that as the Schiller ratios rise, the average expected return drops like a rock. And that makes perfect sense. It's like almost think about anything you buy in your life. If you pay a lot for something, you probably get less from it on a future basis. If you pay very little, you get a bargain and you probably feel better about it on a long-term basis. So when the Schiller ratio is high, there are no bargains. And when it's low, there are tons of bargains is the way to think about it. And that's the way the cyclicality of markets works. So now focusing on that orange line for a second, this is back to the terror. So the best outcome on a forward 10-year basis for the S&P 500 at this level of the Schiller ratio was 4.7% per year. The worst was losing 1.4% per year, and the median was less than 3% per year. So when I was mentioning earlier this whole idea that philanthropic capital, which is heavily allocated this way, is a gigantic risk, that's the reason. 3% per year for the S&P, 1 to 2% for bonds if you want to be generous, and you've got a problem if inflation's even around 2 to 2.5% per year, and you're spending 5. That's what we're worried about, and it's a massive, massive issue that has to be considered. Now, you could say, what if this time is different? And I would say, well, just like I said before, I can't guarantee it won't be different, but we don't like making investments where we're betting that basically 130 years of history is wrong this time. That feels like a very, very risky thing to do. We'd rather use the logic that's implied by a simple idea, which is pay less for things and you'll probably do better, and pay too much and you'll probably be quite sad when this is all said and done. So we flip to the next page. Here's our other problem. Which is that you don't need to be I don't even know why I show this graph sometimes. Everybody knows that the markets are going through an incredible speculative bubble unstoppable right now. Whether it be, I hope I don't offend anybody, whether it be Bitcoin, whether it be GameStop, whether it be Tesla, pick any name you want to something that is just complete insanity. And this is what euphoric markets look like. So this is a really interesting graph that the people at Citigroup put together, which measures euphoria and panic back from 1987 to date. So the first thing you see, and I'll tell you what this index is in a second, you can see that the euphoria level, which is the beginning of this year, I think it's probably a little bit worse today or higher, i.e. it's extremely high at the beginning of this year, even higher than it was back in the TMT bubble in 2000. Most of us are mature enough to remember that bubble. So an extremely high euphoria rating today. Now, just to give you the definition, a euphoria rating that as they measure it is based on newsletter writers who sell their advice to clients, investors. If they're very bullish, i.e. optimistic, that's bad in terms of euphoria. If there's a lot of options trading, that's another sign of euphoria in the markets. And if there's a lot of use of margin debt or borrowed money to invest money you don't essentially have, these are all signs that people are feeling really good about the markets, and that's really bad for them, just to be clear. And I know it's all backwards, but that's how it works. And the problem with this graph is we don't care about it as long-term investors. It's irrelevant to us. But you have to think about what it means in terms of the short-term implications of even a really well-valued portfolio. It's a buckle your seatbelt warning is really more than anything else. It has nothing to do with the long-term return implications, other than to give us opportunities, which I'll talk about a little bit later. So if we scan to the next page, or move to the next page, excuse me. Let's circle back to where we were before, which is we're trying to preserve the purchasing power of the assets. And one argument you can make, which at first sounds really compelling, is, well, let's say you accept my S&P 500 analysis. If you do or you don't, let's pretend you do. But let's just pretend that's not the issue. Let's just say, why don't you just put 100% of the money in the stock market, in the global stocks, which are actually reasonably attractively priced today, even with the S&P as part of that. Just put it all in there and things will turn out great. Why do you need all the complexity of that asset mix and your specialized global equities and all these other things that, by the way, all cost money, right? The fees are definite, the returns are just hoped for. So the problem with that, though, is that diversification doesn't just let the foundation's board and Alicia and the investment committee sleep at night. It actually contributes to the value of your funds. And so if we turn to the next slide. Oops, one more slide. There we go. Slow on my screen. I hope you guys can still hear me okay. Am I frozen? Oh, go back. Perfect. Good. We're still okay? I'm sorry, I'm making sure you guys can hear me okay. You can.
Yep, you're doing good.
Thank you, Nick. Sorry. Sorry about that. It seemed like it was freezing. I'm always worried about my Wi-Fi. So we wanted to bring this idea to life that the returns always matter, but how you earn them also matters. And so if you earn higher returns, but you have a lot of bouncing around all the time, that is not necessarily a good thing. And this is all, so as you need to do about taking that volatility, because if you destroy the value of return. And so I want to illustrate this, and the best way to do it through this graph. So what we're doing here is we're looking at basically a hypothetical analysis, but with real returns. So we pretended that a $1 million fund showed up on June 30th, 1995. That date, by the way, was picked because that's when we started working for the foundation, just to be clear. That's when the returns date for our tenure with the foundation started. That $1 million shows up in 1995. What then happens is it is invested in one of three portfolios, the community foundation portfolio. Those are all the returns I showed you earlier. Those are the blue bars. In a simple, basically owned global stocks, that's the orange bars, and in a 70-30 mix, which is the other index I showed you earlier of global stocks and bonds. And what we did then, we took out 5% per year over this entire, basically 26 some odd year period. And we didn't add any capital to the portfolio. So the million showed up, nothing was added, 5% per year comes out. And the only difference then is where it was invested. So then what we said is, okay, what was the ending fund balance as of February 28th of 2021? And the blue bar reflects that. And you can see it's higher than either for the orange bar or the gray bar. But that's not actually that big a surprise because the foundation actually outperformed those indexes over this time period. So, okay, of course there was more money in the fund at the end. You showed me the performance was better. But now look at the second set of bars. which was what was actually taken out of the portfolio, which was also higher. So in a sense, that ending fund balance is understating the return advantage that existed. And that's because the spending is higher, so more coming out. And you can see the far right-hand set of bars just adds the first two set of bars together, just so you can get the sum of the impact of higher returns. And what I'll show you in a minute is lower volatility. So underneath this, there's two bullet points I just want to draw your attention to. The foundation's performance over this period of time was just under 16 percentage points above global stocks. That's again, this whole 25 plus year period. That's one thing. But if you actually were able to, if you had my spreadsheet and you could do the math, what's the difference between that blue bar on the right and the gray bars on the right, or the red bar on the right, orange bar, excuse me, it was 31% higher. So 15.6% in more additional return generated 31% more dollars. And that's an incredibly important point. And that happened because of the last bullet point, which is while the portfolio outperformed, was also less volatile, less bouncing around than the index. And that's what we're trying to achieve, which is outperform and moderate the volatility to an extent that doesn't cost us the outperformance. So like I said, it's not a perfect, just lower the volatility and everything will be fine. It's not the point. It's lower the volatility in a way that's commensurate with, or even a little bit better than the returns that we're not going to give up. So one more slide. It gets even worse though for the indexes. If you look at this next slide. So this slide takes that middle set of bars, the spending I showed you a minute ago, and essentially looks at the year to year, just blows them up year to year. And the blue bar, the blue line in this case is the Community Foundation portfolio. The orange line is our global stocks, and the gray line is the 70-30 like we showed earlier. And you can see some pretty disturbing trends if you're in the index, which is that back in 2002, essentially, the All Country World Index, the ACWI that we're talking about, global stocks, it peaked at about $70,000 in distributions per year, and it didn't get back to that point until 2017. Now, juxtapose that with the blue line, which is the Community Foundation portfolio, and you can see it's not always going up, but it doesn't go down for very long. It stays flat sometimes, which we're also trying to avoid, of course, but we can live with it, I would say. But it generally heads higher. And that's, again, a consistently applied strategy that's very much focused on this between risk and return. And then the last one to say, because you can see here, is take a look at the very far right-hand side of that blue line. You can see how it's just sort of just meandering along. That's the 2020 collapse in the markets, and that's the beauty of a 20-quarter average and using an average to smooth these things out. And by the way, the average is being applied to all these lines, not just the Community Foundation line. And that's why we are able to take on the 72% risk you saw earlier, equity risk I mentioned, because we know we have an averaging formula protecting the distribution rates from your funds. And we'll deal with the 5-year implications of that by having a diversified mix. So we go to the next slide. I feel like I've given you a lot of doom and gloom. Don't put too much of your money in the S&P 500. The bond market is what it is. And you got to get to the beginning, which is, well, if you're going to achieve CPI plus 5, let's call that a 7.5% to 8% return, how are you going to do that if some of the big tools at your disposal have been removed? And that's where the dichotomy in the world is so interesting today. So the S&P 500 might be really frightening for a long-term investor's perspective, but there's a lot of things that aren't. In fact, a ton of things that aren't. We're like kids in the candy store recently. The markets, anything that is not popular, anything that's cyclical, anything that's boring, is really cheap these days. Not anything, but a lot of things are. And this graph that you're looking at here, one more technical graph, and this is my last one, I promise that's technical. You can see this is a difference in valuation between the Russell 3000 and growth. So think of that as US growth companies, mostly the larger ones, by the way, that dominate that index, versus value. And you can see it kind of meanders along from 2007 all the way to 2016 or so, with growth being a little bit cheap at times. And then it plunges on the right-hand side of the screen. And that's the value disaster that's occurred. So value investors, and by the way, if I don't like to do excuses, so you haven't heard me give one yet, and I'm not going to now, but if you want to ask a simple answer to the question, why is your portfolio not done as well the last 5 years as it had before? This graph is a huge reason for that. We own not all value stocks, we own a lot of value stocks. And we do that because they're not just cheap compared to growth, they are just cheap. We talk to investors all day, and we are just stunned that people are selling us stocks at these prices. It makes absolutely no sense. They can't get enough of whatever growth story gets people excited these days, and they're just giving away companies to the rest of us. And so it's frustrating when you're being compared on a performance basis to own things that you know are incredible on a long-term basis. But we'll sit here all day, and I hope I don't ever cause you to lose confidence in what we're doing while we're waiting for this to turn, because it will turn, and when it turns, it will be incredible. And I think that's a really important part of this equation too. So last slide, I believe, or two more, sorry. So here's our strategy. We can overcome the S&P 500 problem and the bond problem by continuing to do what we've always done, which is stick to contrarian investments. Let people give us free money because something's complicated. Let them give us free money because we're more patient than other people are. Let them give us free money because we're not trying to make a short-term prediction of any kind. When I say avoid ideas where you have no edge, that was the points I made earlier. We're not going to figure out what the economy is doing this year. We're not going to figure out when investors are going to like bank stocks again, but we are going to stick with the idea of buying things for a lot less than they're worth, making sure they're good quality investments, and then just waiting it out. That is basically the whole point of this strategy. And patience in a long-term horizon generates larger return premiums during challenging periods. So that's that euphoria panic index I showed you earlier. That graph is going to be scary when it turns the other way. It might even be doing this as we speak, but when it does, it's going to be scary in the short term, but it's going to be a very, very sweet thing for long-term investors because the bargains will abound in even more places than they do today. And we're sitting here just waiting to take advantage of that, both at the foundation level by allocating capital to great investors, and then great investors themselves are doing that as well. And then last but not least, the capitalization of the foundation. The ability of the foundation is a large institutional investor with a great reputation and the scale to access just an incredible group of investors. These are not people you read about in the papers. We have a global research effort, which I haven't talked about today, that literally goes out and finds people everywhere in the world, the best people we can find at any point in time. And we make sure that the best of the best, we hope, are in this portfolio. And so finally, one more slide. We did change our name, as many of you may know. We decided we wanted a name that reflected the idea of teamwork, and competitive rowing is what this purposeful misspelling of crucial is. So we feel like if we do a good job, it's crucial to the success of your funds. And the play on words is that competitive rowing is the ultimate team sport where everybody needs to pull those oars if you've been involved with that sport. And if someone doesn't, the whole boat stops. And so we need to make sure that we're good teammates to the foundation and to you. We are 100% employee owned. You can see our capital base is about 37 billion today, and we have 71 employees. So I'm going to stop there, and I appreciate your attention. And if you have questions, I'd be more than happy to answer them.
Yeah, thanks, Mike. Again, if anyone has any questions for Mike, he's probably going to hop off this call. You can type it into the chat or use the raise your hand function, and we'll call on you. So that way you can unmute your mic if anybody has any questions.
Can you hear me?
Yes.
Mike, can you continue talking? Because since you've been talking, the Dow has recovered 200 points of its 600 point downdraft. So the longer you talk, the more we're going to capture.
I love that. Can I tell you a quick story, if you don't mind? Years ago, we worked for a big university in the Southeast, and after a few years, the provost came up to me and said to me, he said, I've noticed that the day before every meeting, no, the day after you come to campus, the Dow drops. He said, so I think we should think about firing you because then the market won't drop anymore. So I think that might be consistent with your point a minute ago.
On a serious note, can you break down the specialized global equity piece a little bit for us? Give us an idea. It's whether it's Asia, Japan, China, whatever the case might be.
Yeah. So it's a bunch of different things. I'm going to bring up my schedule, make sure I get it right. But basically, the first thing that's in there is actually a manager focused on Japan. So I'm glad you brought up Japan. And that manager is actually an activist in Japan that has, we think, an incredible ability not just to buy inexpensive businesses in Japan, but to actually work to turn them around, taking board seats and doing things that really make a big difference in terms of how Japanese stocks today are priced or not priced very well. Other managers in that portfolio are an incredible global equity manager based in Hong Kong, actually, who invests somewhat in China, but also in India and Europe to some degree as well. So one of the things that we really love to do is find people sitting in different parts of the world because they see things differently than we do here. We also like to diversify by age, gender, and ethnicity because we find that people really do see the world very differently. And two more quick examples. We have two very concentrated value managers in that part of the portfolio. They're both based in the US and buying US stocks. One is a firm, I'll give you names you want, but one is called Ampfield Partners, which is a small New York City based manager he's a relatively young portfolio manager. He's been around for about 6-7 years now in business. Incredible investor, loves to buy, believe it or not, don't be horrified, loves to find retailers that are being misunderstood in the Amazon effect. And he's done incredibly well with companies like Ross Stores and names of companies. Not every retailer is going out of business because of Amazon. He also likes to buy into roll-ups where you actually serial acquirers. That's another thing where if you're, and as a CPA on this call knows that acquisitions can be complicated from an accounting perspective. And there can be shenanigans too that go along with that, but not every roll-up company is doing anything that's shenanigans. So he likes to go to that area. And I bring it up only because it's a perfect example, both of them are, of where if you're willing to do the hard work as an investor to figure out which companies really are good and not make simple decisions and use simple metrics, you can have a huge advantage over other investors. And that in essence is the specialized global equity category, are people who are just literally making very strong allocation decisions, which can, by the way, create volatility compared to benchmarks. When we put them together, we don't think the aggregate portfolio will be that way at all. And furthermore, we think they can add a ton of value to the portfolio, which is why we put them in that category.
Okay. Thanks.
Okay, we have a couple questions from Anita. Do you want to go ahead and ask, or do you want me to? I can read it from the chat. So she goes, she asked what Mike's guess regarding the market performance is.
Oh, Anita, my guess, for what period of time?
What this year is going to be. You mentioned that, you know, you had an opinion regarding what the performance was going to be. So naturally, you're the guru on this call. So I'm interested in that opinion.
Oh, I think I know what the 10-year performance is going to be, Anita, but I'm not going to get away that easy. I know. I'm going to try to answer that question.
Yeah. Right.
My guess is that the markets have a tough year this year. I hope no one quotes me on this because I am literally, my guess is no better and probably worse than everyone else's on this call, to be clear. I have no idea. But I will say, if a market can do as well as it did when the economy is terrible, like we saw in 2020, then why can't it do badly in a year where the economy is probably going to be pretty good? Even though I promised I wouldn't make such forecasts before, but it seems like between vaccines and a lot of other things, there's every reason to believe that the economy will start to heal this year, and that will probably look pretty good. But my bet would be the markets at best are very low returns and probably negative returns for the year.
Really? Okay.
What's that portend for gold?
However,
Low to no returns.
I think gold could, it's interesting. Gold's complicated today because one, I think gold it's starting to price relative to interest rates, and it seems to be getting hurt when rates rise to some degree. So if interest rates continue to rise, which I want to get to in a second, I'm not sure that's great for gold. And I think gold's got some competition for Bitcoin these days around how people think about, you know, just the whole idea of fiat currencies and those kinds of issues. So I don't know how the competition with cryptocurrencies really affects gold, but it seems like it could. We don't invest in any of those things, just to be clear. So I feel like an ignoramus trying to answer that question, but I do think, I think it's going to be tricky for gold. But I want to say, if I might add back to Anita's question too, if interest rates rise, which I do think is a reasonable thing to say they will, and because frankly, not because they will, but because they should. They're too low today. They don't make any sense. Inflation is going to be higher than interest rates are at the moment. And I will say this, and this is where I'm going to stick my neck out on a big limb, and Alicia and Nick are going to shoot me later. But even though I gave you that market forecast before, I would not be surprised if the portfolio actually did make money, even if the markets didn't in 2021, because we are the same things that made me feel like the dumbest investment advisor in the world a year ago when the returns were terrible and they were below the markets. The same exact opposite would happen in a year where rates rise and people are actually, economic activity is a little more normal. This portfolio is so cheap today that to me, it's very hard to see how much more, I don't think it could fall that much from here without bouncing back really quickly, just like the markets have done today, I suppose.
I took notes on that, Mike. So I wrote it down verbatim what you said. So then we can report it when the year's over. We'll measure we'll measure your prediction. All right. And then the other question I wrote
Yeah.
was
And
values. What is it, Mike? The other question was the value stocks.
I expect to know less.
He's going to delay. So
You want?
he's delayed a little bit in a second. No, he keeps freezing up.
You're sticking, Mike.
Oh, we may have lost Mike.
There he
He's
is.
back.
There you go.
Oh, no, I'm back.
Oh,
I'm back.
there we go.
All right.
Okay.
All right.
Forgive me. So what are examples of value stocks, Anita? Was that your question?
The categories of the value stocks are inexpensive. They're such a great deal. They're amazing. So what are your favorite categories of value stocks?
We think banks are really interesting. We think travel-related businesses are really interesting. And frankly, anything in Japan that's not tech is really interesting. I mean, it's really, the list goes on and on and on. It's remarkable. And two other quick points that I might make. When you talk to really good value managers today, they say two things. One is that they're just stunned by how much quality, business quality they can buy at these prices. And business quality being defined as some growth, by the way, so not just stagnant businesses. 2, companies with really good balance sheets, and 3, companies with actually very good management teams. Usually value investors, in most times in the world, you do get what you pay for. And if you buy something cheap, it's cheap for a reason, and you're betting on it being a little less cheap in the future, or you're betting on the company doing something that people don't understand that will make it more valuable. But today you don't have to worry that much about that stuff. You can just buy boring businesses, and if they're in the wrong sector, the wrong part of the world, or whatever, no one's paying any attention to them, and they don't care that they're cheap. And to us, that smells like opportunity.
Okay, any other questions for Mike before we let him jump off this call? All right, well, thank you, Mike. We appreciate it.
My pleasure. Good to see you all. And I hope I'm not held too closely accountable for that market prediction. We'll see what happens, of course.
You're amongst friends, Mike. Thank you.
Thank you, Mike.
I know that. Anita. Thanks, everyone. Take care.
Bye.
All right, now I'm going to introduce our president and CEO, Alicia Dix, to provide a few updates on what we've been doing. Alicia.
Thank you. And it's good to see a few of you. We were expecting a few more, but we know that these are challenging times, and getting people's attention, especially through Zoom, is sometimes a challenge. It's always great to listen to Mike Miller. I always learn a little bit more, but I want to play a little bit of a math game with everybody. So over the last 70 years, the Community Foundation has raised over about $140 million. And we recently just passed our threshold of investing $100 million into our community, which is an extraordinary number. I just wonder, what do you think our total assets are worth today? I'll give you a second to think it over. So we've invested 100 million and we've raised 140 million. What do you think we're valued at today? Wasn't going to ask you to put it in the chat, but if you have a number, let's see how close you are. We're at about just over $180 million. So if you think about those numbers, this really demonstrates the power and the value of a healthy community endowment. And we're so fortunate to have partners like Mike Miller consulting our growth, our trustees and our staff who are constantly providing the best due diligence and drive for high performance. And most importantly, our fund holders and donors for their dedication to our community. We would not be here if it was not for you. So pretty extraordinary when you think of those numbers with our success rate here. So 2020 has been, we've heard it all before, an extraordinary year. And a year that we've all had to pivot and adapt deeply. As you know, COVID has caused many challenges across the country. But in our community, I have to share how grateful we are to our donor advised fund holders. They really stepped up last year. We awarded over $6 million through our donor advised funds to nonprofits, many of which, as you know, were very, hard hit over the impacts of the pandemic and COVID. This was a record-breaking year, the most given annually by our donor advised fund partners. So again, congratulations to all of you and all of our 400 plus donor advised funds and fund holders for really stepping up in a way that our community, when our community really needed it. So last year, we opened our COVID fund. Many of you participated in that fund. We were able to award through that fund alone over $1 million of support toward 70 plus organizations in our 2 counties. Again, very important work that needed to get done to sustain some of the essential needs and services and programs that many of our community residents depend on. In January of 2021, along with United Way of Mohawk Valley, we ramped up the fund again to try to deal and combat with any other COVID-related needs, whether they were in response or recovery. We'll continue to be working with our nonprofits through their needs during this pandemic and as we come through recovery through the vaccination process. Many of our nonprofits were not only impacted financially, which I think we all are well aware of, but they also lost a considerable amount of talent. You might have heard the national numbers where a lot of the workforce has separated from the work environment. Many women, because of homeschooling and remote access, have left the workforce, and our area nonprofits have not been immune to that. A lot of them are now looking for new talent. So there are a lot of challenges other than just what we might expect in the financial realm. It's just sustainability and getting their programs, training, and other needs for the nonprofits to get through this COVID recovery. And as we transition from our response to COVID, which is a lot of PPE, personal protective equipment, remote access devices and equipment, laptops, all sorts of needs that we were able to support, we have been turning our attention to supporting the vaccination process with an eye towards getting the most vulnerable and underserved residents in our community vaccinated. I have been heavily involved as I've been serving in the last few months on the New York State and the Mohawk Valley Equity COVID-19 vaccination task forces. Also been fortunate to serve at the SUNY Poly Super vaccination site to learn what we can from the mega sites to bring them down, those resources down and processes down to smaller pop-up sites in our neighborhoods so that accessibility can be available. So there are many challenges we're working through to overcome, from education and awareness of the vaccination process to vaccination registration, and ultimately access to getting the vaccinations for all our residents. So COVID has transitioned, but we still remain open for those needs. We just did a grant round. I think we're a little over about 20,000 in 2021 of support for COVID related needs. And again, we'll be looking towards those vaccination needs as well. The other, obvious national stress has been on equity. 2020 challenges have opened many doors. COVID opened many doors for new collaboration. And I think the equity attention on the national stage has opened so many more as we consider our own community needs and doing better when we are attempting to get equitable outcomes. So we have been stressing the importance of tackling our community's concentrated and historic disadvantage for a long time. But last year, our board took a bold step and made an equity commitment of $10 million over 10 years as an initial investment that's going to be focused on all aspects of equity related to race and gender, religion, and other socioeconomic factors by inclusively uniting people, partners, our institutions and resources to produce significant, long-lasting results. You know, equity is now at the center of all our work. It was always there, but now it's being called out and it's really taking center stage. We're looking to leverage resources, not just local and area resources, but bring in national endowed dollars for some of the equity work we're taking on. We have been working hard to develop an equity advisory group that will help guide us through some of the more pressing issues and challenges on the long-term horizon as we unpack our work. And we've already made some early investments in diversity, equity, and inclusion training. And again, access to vaccines is high on our list for equitable outcomes. And our initiative work, such as lead and workforce, are all kind of being retargeted towards equity and more equitable outcomes as well. So our work has just started, and like our lead initiative, we are in it for the long haul. The last slide I have here to share with you, and I guess we just wanted to give you a few of our updates. We're changing the way we invest in our community and calling grant making something very different, inquiry to investment. And before I explain a little bit about what we're focusing on with our nonprofits and what we're encouraging from them, before I get into that, I want to take a moment to congratulate Lindsey, who I know all of you work very closely with. But through this reorganization and refocus, we really wanted to align our donor strategies and our donor relationships with our community investment strategies. So Lindsey's been promoted to Director of Donor and Community Investment Engagement as part of a restructuring process to adapt to this new way of working. And we're really excited to have her lead our team and our work in both these aspects. So she'll bring our work closer to you and donors closer to our community needs at a greater capacity than she's been doing in the past, which is hard to beat. So what does this new strategy mean, and how did we get there? You know, through 2020, what we learned is that we really can't afford to sit back and say the way we have always done things is fine. We need better outcomes. Our residents deserve the best we can give, along with our nonprofits and our donors. So we need to challenge what and how and why we do our work and look for opportunities to do better. Everything changes, and that is the only constant that I know. And the Community Foundation wants to adapt and align our work as a strong community partner with our community needs and our nonprofit partners. We have transitioned as a convener. We convene to make changes, and change is how we're going to adapt and grow. We're really trying to encourage resiliency in our nonprofit partners and some of our other partners, government and for-profit as well, and build capacity for successful programs and partners, more so than we've ever been able to do through the grant-making process. So this new way of working, we've been at it for over 5 years, and we've learned a lot through many of our own initiatives and our strategies, and especially through last year's crisis with the pandemic and equity. And I think we've learned that we need to adapt to a process of engagement with our nonprofits and listening and promoting better outcomes to work together and collaboratively. So that's different than a grant making process. So our adaptive strategy is more of a collaborative model, and we hope to encourage our partners to engage and improve and innovate their programs and services. So we feel an obligation to help our community and our nonprofit partners thrive we're listening and learning and adapting and mobilizing our resources around important community challenges and listening to our community residents to gain their support and perspective as we make these critical decisions. You know, we're talking about solution-based investing. We're talking about using data to help us make better qualified decisions, prioritizing collaborations and nonprofits working together. That really is one of our primary goals. A lot of them can't do things alone anymore. They really need to come together, take some risks perhaps, take the time to do some breakthrough thinking about how they're going to address their work, and hopefully we could be there by their side to try things differently. But we have many tools to cultivate. One of our greatest tools is our donor advised fund network. We have over 400, as I mentioned, and all of them are going to help us participate and meet the demands of our community in a more collaborative way. So this inquiry to investment strategy is really a way for us to hear the needs, cultivate new strategies with our partners, and instead of working to respond to them, we want to be a true partner with our nonprofits. So we want to be working with them. Together, we're making important investments in our community to get the outcomes that matter most. And that togetherness isn't just us and our nonprofit partners. It's you, our funders. It's our funders that have yet to be identified, who we're trying to encourage to come along for our journey. And we always are looking for opportunities to hear from our funders and from our nonprofits. But I hope this is a helpful presentation so that you kind of understand where we're trying to gain some better insight into the needs. We'll be open for proposals for 6 months starting on April 1st. And our nonprofits have already responded well to this new way of working, this inquiry to investment strategy. So this is a pilot year for us, and we'll be testing it and figuring out how to adapt, improve, or make some changes if necessary as we advance this new strategy.
All right, thanks, Alicia. Now I would like to welcome Lindsey Costello, Director of Donor and Community Engagement, and she'll talk about some of our donor advised fund holder support. Lindsey.
Thank you, Alicia. Good afternoon, everyone. First, I would like to introduce Allie Campbell. Allie was a summer intern at the foundation in 2019, and then she worked for us part-time up until January when we brought her on full-time. Allie assists us with our newsletters, our donor updates and communications, and our nonprofit research. I just wanted to take this opportunity to welcome Allie.
Hi, everyone. Good afternoon.
Thanks, Allie. So as a reminder for all of you, you have access to our staff team. If there's a nonprofit organization that you would like more information about, we can do the research and get back to you. Also, if we know what programs or areas of interest you are passionate about, we can let you know when funding opportunities arise that align with your philanthropic goals. Each quarter, along with your fund statement, you receive a newsletter that was created solely for you, our donor advised fund holders. The newsletter contains foundation news and updates, stories about other fund holders and local not-for-profit organizations, along with a variety of funding opportunities for your consideration. If at any point you would like more information or have more questions about your fund or a not-for-profit organization, please reach out to me or Allie. We would be happy to schedule a time to speak with you. Last on our agenda for today, our Director of Giving Strategies, Nick Grimmer, would like to say a few words. Nick?
Hi, everybody. And I will spare you from a long discussion here, but I just wanted to take this opportunity for those who are able to join us live, and also the folks who have indicated they're going to be able to watch the recording that we'll send out after, that if you have any needs when it comes to planning your giving strategy, whether it's your current giving or giving in the future, use us. Whether or not if something falls into place, I mean, that would be a wonderful outcome, but we have many resources. We've done a lot of research on some effective ways to structure giving, especially with some provisions that have been enacted temporarily under the CARES Act. So whether or not the funds would come through the foundation or these would be direct gifts to other charities that you'll use on the side, talk to us. Again, like Lindsey said, when it comes to our partnership, it's not just transactional. We want to be part of your planning, and we want to offer our services. So we certainly have many ways that you can plug into the foundation and replenish your fund, or create a legacy plan for your fund in the future. But we also can talk about other ways to make your strategy more efficient, whether it's tax efficient or just structured in a particular way to reach a particular goal. So again, I'm going to put my contact information in the chat, including my cell number. Reach out privately. Everything we would ever discuss would be fully confidential, but we're here to be a resource. And I really hope some folks will take us up on that offer. So please don't hesitate to reach out. And I think I'll throw this back to Lindsey now to wrap things up. But thank you all for joining us.
Thanks, Nick. We would now like to open it up for questions. So if you have a question about any of the information that you heard today, please either type it into the chat box or use the raise your hand feature located at the bottom of the participants panel, and we will call on you to unmute and speak.
Lindsey, I don't see the hand, but I've unmuted. Can you hear me?
Yes.
I want to ask Alicia, given the problems we've had over the last year and the new initiatives launched and the effort to engage not-for-profits in a new manner, have you found any instances where there's overlap, where it would make sense to try to consolidate some agencies that are performing the same task and trying to address the same populations and problems? You know, I think the last time I remember there being a big push in this area, not a push, but the result of federal policy was during the Reagan administration. I think it was block grants caused a lot of not-for-profits to lose their funding. And so there was a natural effort to combine and try to reserve resources and get the best bang for the buck from an agency point of view. You seeing any of that now in your discussions with the not-for-profits and the areas they're trying to address?
Well, Jerry, I have to say you cut right to the center of this new strategy without us saying that definitively. This is all about alignment with nonprofits who, prior to COVID, many of them were pretty much on the rails. You know, I would say over half of our nonprofits were within 2 months of payroll, and then that's about all they had. Now without, so not sustainable, but now without their fundraising activity last year, with so many state, federal, and local program dollars being cut, whether they're grants or agency dollars, they are now forced to do that capacity building consideration that, you know, we've been at it for years. We used to call it capacity building. We've had some successes in bringing nonprofits together and aligning, whether they merged or had a service agreement or an affiliate agreement. You know, what we've been telling nonprofit partners is there's a great need out there. No funder has enough resource collectively to meet that demand. So we've got to partner with them so that they can find new solutions. So there was a line in my presentation that said risk. We're looking for folks to take risk and breakthrough thinking. That was another way of saying, can you consider a new future for your nonprofit organization? And that's sustainable, right? And not just dependent on some dollars that, you know, quite frankly, right now are in short supply. I'll say that, but then I'll kind of invert this by saying if there is a nonprofit that is investing in a way that the outcomes are exceptional and necessary for our community, showing great results, I would say we would probably keep them sustained, find a way to find other funders, because we don't want services that are working to fall short and, you know, just go unfunded. So there's a little bit of dexterity in our decision-making when it comes to bringing the best out of our nonprofit community, but I think we're poised with them. They've heard us talking about this for over a year. And like I tried to say this without saying it directly, but COVID open doors for us in that reign.
Yeah.
That was kind of the benefit of COVID, is that it's forcing our sector of the economy, the nonprofit sector, to look at a more efficient model.
Yeah, it's pulling back a lot of onion.
It
all
is.
over, all over in all sorts of areas. Yeah, yeah. Okay. Well,
Yeah, I
thank you.
appreciate saying that.
Thank you.
Thank you.
All right. If anyone has any questions, please feel free to reach out after this, but I think we've answered all the questions.
Okay. Thank you all for
Can I
joining.
just, Alicia, offer one point of clarity? I had said that we have 400 funds. They're not all donor advised funds. We have about a little over 100 donor advised funds. I want to be accurate. We have 400 plus fund holders. Is that accurate, Lindsay?
Yes.
Thank you. Okay. I just wanted to make that clarity. Thanks, Alicia.
Alicia. All right, so thank you all for joining us. We are really looking forward to seeing you in person soon, I hope, maybe this year, hopefully. But we hope you have a wonderful afternoon, and thank you again for attending.